Hello, everybody, and welcome. This is my video on creating a classified balance sheet as well as a multi-step income statement. The information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2021 by Bennett Tchaikovsky, and all rights reserved. Any distribution is strictly prohibited. So what I've kind of found is that as I'm going through and teaching financial accounting, the way I would typically have things taught is I would start out with basic financial, or I should say, recording and summarizing financial statements. That generally is going to be my exam 1. And then exam 2 is adjusting journal entries and also preparing financial statements. And this includes, though, a classified balance sheet. And as I was going through in exam 3, which typically deals with inventory, exam 4, which is going to generally deal with internal controls, bank reconciliations, accounts receivable, as well as property, plant, and equipment, and intangibles. And then you have exam 5, which is going to deal with current and non-current liabilities, generally going to be bonds, loans, as well as owner's equity. And what I found is that as I was teaching, then your final exam, which is generally going to be cash flows plus financial statement preparation, what I found for students is that if I gave these 3 exams without reinforcing the concepts of a multi-step income statement, which is not really even taught over here, this is really where it's first introduced. But if I don't go through and reinforce those various different concepts, when the student will come to the final exam, that's really when it becomes a lot more difficult. So what I've done over here is I've gone through and I've created a classified, or basically I've done a post-closing trial balance. And so this is really a good kind of review in terms of how to go through and to look at making a classified balance sheet. So before we go and look at any, before we go through and we look at the preparing a classified balance sheet, I think it's always good to first go through and to see, like, how do companies go about doing this? Like, so for example, the reason why I like Apple is that Apple will, right here in their classified balance sheet, they make the distinction between current versus non-current assets. And this is as of December 26th. They're on a 9/30 year end, but they'll do the same with liabilities. They'll break each one of these out and then, show each one separately. I think it's extremely important, and I kind of like the way that Apple goes through and discloses this. When you start looking, though, at other companies, if I take a look at Facebook, what you'll kind of start seeing is that, well, Facebook does things a little bit differently, and there's nothing wrong with that. It's just they do things slightly differently. If I look at the Facebook quarterly report, right over here, what you're going to see now is that, well, and you'll generally see this with all companies, is they'll come out and they'll say, okay, current assets, but then everything else gets dumped. It's just kind of listed below. And so you kind of look at this and you kind of see, well, is this proper disclosure? And look, there's nothing wrong with it, because clearly the from a financial statement standpoint, the clear disclosure that has to be made is what is a current asset versus a non-current asset versus current versus non-current, and then current liabilities versus non-current. But I like Apple just because the way that they go through and they're actually totaling up their different, liabilities. So I bring this up to you because there's a lot of different ways to do things. The other thing you'll notice is that as I'm about to go through and teach you, I'm not going to make you go through and you won't find all these columns here that look nice and neat. Rather, what I tend to do is I like to show you where these numbers are coming from. So let's go through and start with Zack's balance sheet as a 12/31/22. And so we're going to start with our assets, right? And this type of problem, I'm pretty much giving to you the full post-closing trial balance, so you don't need to worry about computing anything else. So under our assets, we're going to separate these into current and non-current. What's the difference? Current is we're going to be using it in the current year. Non-current is going to be beyond the year. So over here, so current assets, I'm going to have cash over here at 375. Then with accounts receivable, right? Accounts receivable is what I expect to collect from customers. But the important disclosure is, what do I ultimately expect to receive? So I have to take accounts receivable less the allowance for doubtful accounts, gives me accounts receivable net. And when you see me do this over here, I'm doing this for you as an beginning accounting students. Now, typically, if you look at Facebook just shows over here accounts receivable. They're just showing you the net number. They're not showing you the exact computation. I'm doing that here because I want you to understand where the numbers are coming from. So typically, you wouldn't be doing this on a financial statement. Over here, you're going to have inventory. That's generally going to be considered to be a current asset. And then over here, we'll also have prepaid insurance. Could also be just other prepaid accounts or other current assets. That's fine. Okay, so my total current assets is going to be right over here. The sum of these values right here are 477. Now you might be asking me, Bennett, why are you going through and showing us the columns in this particular way? Why are you doing it this way? It is because I want you to understand that if I'm taking, so this is AR net is B minus C, which equals D, E, F. Total current assets are going to be my cash plus my accounts receivable net plus the inventory plus the prepaid insurance. We'll say that this equals G. So those are my total current assets. For my non-current assets, okay, I have a couple different things over here. I have property, plants, and equipment. This balance here is at 200 less my accumulated depreciation on property, plant, and equipment, which is going to be a negative 50. Remember this, the accumulated depreciation is a contra-asset account. It's going to have a credit balance, and it's going to reduce the carrying value of our equipment. So I'm going to have over here PP&E net. And so notice going back over here to a company like Apple, when Apple shows their property, plant, and equipment, they say property, plant, and equipment net. That means net of accumulated depreciation. Accounts receivable net, that means net of the allowance for doubtful accounts. So over here, I got property, plant, and equipment net. My next one over here is patent, okay, less accumulated amortization on the patent. And this is not necessarily that it's controversial, okay? Is just that this is the way that I choose to show it, right? And if I look over here, let's take a look at intangible assets net, right? So this basically means net of any amortization. What's an intangible asset? Patents, trademarks, goodwill. Those are all examples of intellectual property or, intangible assets. So my patent net of the accumulated amortization is going to be here at 19. I then have goodwill, which is also an asset. What is goodwill? When I buy a company, the excess of the fair value or the purchase price, or the, excuse me, what is goodwill? If I buy a company for, we'll say $1 billion, the fair value, the net fair value of those companies' assets, we'll say is 400 million. So that goodwill is going to be 600 billion, or excuse me, 600 million. It's that excess amount over the net fair value of the assets when I buy the company. So when we look at Apple doesn't actually really have any goodwill. But over here, for Facebook has, as of September 30th, 2020, they had about 19 billion of goodwill. What does that mean? They've made a lot of acquisitions: WhatsApp, Instagram, Oculus Rift. All of those acquisitions that they've made, they've paid more than the fair value of the assets. But when you look at the growth that Facebook is seeing, and go back and take a look at their financial statements from like 5 or 6 years ago, this number was about 51 billion, and this one here was 19 billion, and look what they've done with it. So they've really made the most of their goodwill. Okay, so then over here, our total non-current assets. This is going to be 100 plus 19 plus 150, or 269. So my total assets are going to be my total non-current assets plus my total current assets, or 746. So when we add up the property, plant, and equipment net plus the patent net plus the goodwill, I get my total non-current assets. And when we add up the total assets, or the current assets plus the non-current assets, we get a total of 746,000. Okay. So last thing, I also made a mistake over here is like, let's put up here amounts in thousands. And what you'll typically see is that basically for Facebook, amounts are in millions. For Apple, also going to be amounts in millions. You can just, it makes it easier instead of seeing these numbers fully extended out. Okay, so this is my assets, right? Remember, what are we doing on our balance sheet? We're showing that our assets are equal to our liabilities plus our owner's equity. That's what we're proving in our balance sheet. So my next phase here is to go to my liabilities. When we have liabilities, again, similar over here to Apple, what we see is that they have current, so that we're, what it's a classified versus an unclassified financial statement. Over here, I'm classifying my assets and liabilities as current versus non-current. Current means that I've got to pay it within the coming year. Non-current is beyond a year. So when I come over here to look at my liabilities, I'm going to start with my current liabilities. Okay, so right over here, my first current liability is going to be accounts payable. This amount here is going to be 85. Now, when I look over here at loan payable, right, due 3/31/23, is this current or non-current? Well, if I have to pay it within a year of the balance sheet date, it's going to be a current liability. So I can have loan payable, and this will be a current liability because of the due date. Okay. Warranty liability, this is generally going to be classified as current unless you have other information. Okay. Now, on the bonds payable, these are all due beyond a year. These are due in 2025. These are due in 2026. So that's pretty much all of my current liabilities. So my total current liabilities are going to be 85 plus 78 plus 16. For my non-current liabilities, okay, And again, when we look at the financial statements of a company like Apple, they're combining everything. But for me and for my class, and the way that I want you to learn this is that I want you to separate out each one. So the first one over here is that the bonds payable, right? These are both going to be due in beyond a year. So what I would say over here is I would have bonds payable. And over here, 100. Now, less discount on bonds payable. This is going to be 12,000. So my bonds payable net is going to be a total over here of 88. Next one over here, and we can also say bonds payable due, we'll call this BP due for 1725, just so we can notate the difference. Then I'm going to have bonds payable due 3/18/16. This amount over here is 200. With the premium, this is going to add on to the carrying value of the bond. Okay. So over here, my premium is 12. When I add these up over here, I'm going to get a total of 212. So as I look at this over here, my total non-current liabilities is going to be, I should call this bonds payable carrying value. Okay. When we have a premium, this is being added to the base of to the principal amount of the bond. So I'm just calling this carrying value. I wouldn't call it net, right? Because it's not, I'm not subtracting something, I'm adding something. So that's why I'm calling it carrying value. Okay, so those are my total current liabilities. So my total non-current liabilities. My total liabilities are going to be my non-current plus my current. Going back over here to the same kind of methodology, QRS, Q plus R plus S equals T. U, V, U minus V equals W, X, Y, X plus Y equals Z. So my total non-current liabilities are going to be W plus Z equals AA. My total liabilities will be my total non-current plus my total current liabilities are over here at 479. Again, the way I'm doing it here is I'm spacing it out, right? I'm showing you, when I'm doing this, typically you could line them all up at once. Why am I doing it this way? It's so you can see how I'm coming up with the numbers. Very important, okay? So those are my liabilities. Now I'm going to get down to my next section, which is my owner's equity. For my owner's equity, I'm going to have two different components here. I'm going to have common stock at par. Okay. So my common stock at par is going to be 1. I have additional paid-in capital. Common stock, this over here is going to be at 99. Okay, this is where we get a little bit funky. Okay, treasury stock. What exactly is treasury stock? Well, the best company to look at if I go to the SEC filings of the Home Depot and I want to say look for quarterly reports, and I come over here to their quarterly report and I want to go back just because I want to look at more specifically, let's go to the PDF. Okay, so if I go to the balance sheet of the Home Depot, what you're going to notice is that treasury stock. What exactly is treasury stock? It's when we buy back our own shares. So Home Depot has repurchased 712 million of their outstanding shares, meaning that they're slowly reacquiring all of their stock. And so that's what they typically do. That's what Home Depot has done for a very long time. So when we come over here, less treasury stock. And this will be a negative number because it's reducing the amount of owner's equity. Okay, so again, treasury stock happens when we repurchase our own shares. So when I look at this over here, you're going to see basically treasury stock as a negative amount. It's because it has a debit balance. Over here, we have additional paid-in capital treasury stock. This will be a positive amount of 33. And then lastly, we're going to have retained earnings. Our retained earnings has a credit balance of 191. So essentially over here is I'm kind of going through and just listing out everything. If I were to be really particular, and we kind of like look at this over here, you've got retained earnings, and then you're showing treasury stock below that. I'm not going to be very particular for my exams, but I'll just do it the way that they're doing it, just for kind of for fun. So this is how we're going to go through and list this out. Why would we have an additional paid-in capital treasury stock? Because if I sell my treasury stock at a gain, I can't record a gain. I have to show it as additional paid-in capital treasury stock. So this is going to be my total owner's equity. My total owner's equity right over here is going to be a total of 267. So my total liabilities and owner's equity is going to be 267 plus 479, or a total of 746. Okay, and we'll call this BB. And so my total liabilities plus my owner's equity should equal my total assets, which it does. So as you're going through and doing these questions, the reason why I'm doing that is that creating financial statements is really important, and it kind of gives you like a bigger picture because we're going through and adding on to this every single semester. So this is really something that you're going to want to make sure that you know how to go through and do. Okay. So that is where I'm going to stop for today. I want to thank you for watching. Please don't forget to like and subscribe. Give that big thumbs up. And I look forward to seeing you on the next video. Have a great one.